Hi everyone, thanks for having me. Really happy to be here. I'm going to be presenting some work in progress, looking at testing whether financial markets are pricing in climate-related risks and using some text analysis. So as motivation, we know that increasingly there's been concern over the macro financial implications of climate-related risks. And one form of climate-related risk we might worry about is that of transition risk. One sub-kind of risk we might worry about is that of policy risk. So the idea here is that to meet our climate targets at some point, or at some points, there's going to have to be increases in climate policy stringency, which will have potentially large and heterogeneous effects on the profitability of different firms. And that in the worst case, that could be to sort of this asset repricing or financial stability implications that Mark Carney spoke about in his now famous speech on the tragedy of the horizon. This is the idea of a climate Minsky moment or a green financial crisis. So despite all of the worry about this in policy circles, it's still sort of an open question as to whether financial markets are responding to those policy risks. So are climate policy risks currently priced in by the market? And of course, that has implications for how much we should worry about the potential for this kind of green financial crisis down the road. So there's an existing literature. I'm going to skip the big literature review for time constraints today, but there is an existing literature in empirical finance which tries to understand whether the market is pricing in policy-related risks. But it's struggled to make progress in part because of its reliance on incomplete emissions data as a proxy for exposure, right? So these studies tend to just regress returns on firm-level emissions, but firm-level emissions aren't reported very well because there are no mandatory reporting requirements. There's lots of gaps in the data. Especially that problem is even worse when we think about scope 3 emissions, which might be what we actually care about when we're thinking about exposure to policy risk. So the aim of this project is to build a firm level measure of exposure to climate policy risk in a more direct way, to use that measure of exposure to test whether there is a carbon premium in the market.
I feel like something will come. Yeah.
Okay. So I'm going to skip the theoretical section of this paper, and again, in the interest of time, but just to get all our ideas clear on what we're looking for in the empirics. So if you think about augmenting a simple asset pricing model, so maybe a long run risk type of model, with climate policy shocks. So you have climate policy shocks, which hit with some probability in every period, and assume, as per the empirical evidence, including from the last presentation, that when those shocks hit, there's going to be a negative effect on consumption, and also a negative effect on the cash flows of the most exposed firms, which is going to be increasing in how exposed those firms are to climate policy. Then if you solve that model, that augmented asset pricing model, what you get is the result that when climate policy shocks hits, there's going to be a fall in one period returns, and that fall is going to be biggest for the firms which are most exposed for climate policy. And in equilibrium, because of the presence of this risk, you should see a risk premium, right? So the firms which are most exposed to climate policy should actually be paying the highest returns in equilibrium, because they should be having to compensate their investors for exposure to that climate policy risk. So if the market is pricing risk, firms which respond most negatively on jump days should be those with the highest risk premium in equilibrium. So that motivates the empirical approach of this paper, where I'm going to use jump days where climate policy tightens to identify normal return responses. Then I'm going to use natural language processing on risk factor data, which I'll say more about later, to construct exposure scores to those climate policy jumps. And I'm going to use those exposure scores to see if the market is pricing in risk. Is there an exposure premium in the financial data? So what I'm going to do today, first I'm going to just describe the data, then the empirical approach to this natural language processing method. I'm going to give you an overview of that I can within the time, and then some preliminary results. So I'm looking at the universe of US listed firms. So I have stock price and accounting data from CompuStat. And then the interesting data which I'm using in this project is this risk factor data, which comes from the SEC. So every year, firms in the US have to submit 10K filings on their financial performance. And one aspect of that is that they have to include a discussion of their risk factors in these reports. So firms are told to include any factor that could impact their future earnings. And investors can sue for compensation if the firm omits material information on risks. So firms have an incentive to be truthful and complete. And as a result, these discussions are often quite long. And increasingly firms are discussing environmental related risks in these part 1As of the 10K report. So for example, Chevron, the big oil and gas company, more than a third of its part 1A last year was about environmental risks. And importantly for this project is that there are machine readable versions. So I can use this text data. So I process this text in the usual way for natural language processing. I end up with almost 23,000 terms. So terms are either 1 word, 2 word, or 3 word long strings of words. And how I represent this text data is I have a v-dimensional vector of counts of each term for each firm. So I know how often each firm is using each term of these 23,000 in each year. And what I'm interested in is which of these terms is most predictive of a negative abnormal return response when climate policy shocks hit. I want to know which terms tell me about which firms are most exposed to climate policy risk. But obviously I have a really large number of terms here, so I need to do some kind of dimension reduction. I'm going to struggle to run a regression with 23,000 right-hand side variables. So I'm using this machine learning method called multinomial inverse regression. So just to make sure we're all on the same page, to recap on the method. So first I pick my climate policy jump days. I'll say more about it in a bit. Second, I construct firm level abnormal returns on those jump days. Thirdly, I'm going to use this machine learning approach to learn which terms are most predictive of negative abnormal return responses on those jump days. And I can aggregate that information to get an exposure score for each firm. And then I'm going to use that exposure score to test whether the market is pricing in exposure to climate policy risks. So I light touch to the machine learning approach because I only have 15 minutes. So as a high level overview, this is a supervised generative machine learning algorithm. You might be familiar with other ML methods that people use in economic applications, such as dictionary approaches, where you take sets of pre-specified terms. What's different about this is it considers all terms in the corpus, so all 23,000 terms, and the algorithm selects terms into the model based on the strength of their association with abnormal returns on the jump day. So the terms which are going to be selected into the model are those which are most predictive of a negative or positive response on the day of the climate policy shock hitting. So I say this is a machine learning method, but really it's sort of econometric, sort of big unstructured data. You can think about it as just being a multinomial logistic regression over a really big number of terms V, and there's some regularization procedure which decides which terms are selected in and selected out of the model. So I have an inverse regression to tell me which terms should be selected into the model. And then I want to move from that inverse regression to a forward regression because I want to test whether this exposure is being priced in by the market. So I follow the original papers on this approach by Taddy and others to define a sufficient reduction projection. So these B's are the coefficients in the inverse regression. So they tell me how predictive each term is of abnormal return responses in the inverse regression. And the nice thing is, if you sum over the term counts multiplied by their coefficients in the first stage, that contains all of the text information which is relevant for predicting the abnormal return. So conditional on this exposure score, the controls in the inverse regression and the number of terms in the 10K report, there's no additional information in the whole vector of counts of terms for each firm, which I don't capture in this set I in terms of predicting abnormal returns. So I use this as my exposure score. So this tells me how exposed a firm is to the climate policy jump days using their 10K reports and their risk factor data. The other nice thing about this risk factor data is right at 23,000 terms, it's really granular, so I can also identify channels through which the shock is operating. And how I do that is I look at the terms with the highest coefficients in the inverse regression, and then I can use another machine learning method, so word embedding here, to build sets of related terms. So terms which predict abnormal returns in the same way and have a similar semantic content. And in that way, I get sort of data generated dictionaries rather than dictionaries taken from expert knowledge or outside sources. And I can also use those in my forward regressions to test whether particular channels are being priced in or not priced in by the market. So then I move from this exposure score to forward regression. So you can do this in two ways. So to the classical finance famine effect type regression that much of the literature on finance and climate change has used, and where I can have either my exposure score or my granular exposure scores based on this weight embedding method on the right hand side, or I can build portfolio sorts, so I can take the 20% of firms with the highest exposure scores, the 20% of firms with the lower exposure scores. And if that portfolio generates a positive return over a period of time, well, then that's indicative of this carbon policy premium that theory says we should see in the data. So what I've skimmed over until now is, well, what are these climate policy jump days? Which is a bit of a tricky question. So we want unexpected climate policy shocks which haven't already been priced in. We want there to be heterogeneity in return responses, and we want to know it's because of the climate policy jump day, not because of something else which is going on. So at the moment, I've been using a narrative approach, so just looking for large, plausibly unexpected national policy events in the US, going back through some climate attention series and going through the peaks. I need to, and finding which ones maybe fit the criteria of a narrative approach. So signing with the Paris Agreement, there's also a number of jump days from the back and forth over the Inflation Reduction Act in the last number of years. Carbon Tax Congress defeats during Obama's presidency. The other option I'm thinking about, so if anyone has feedback on this after, would be happy to hear, is that what I could also do is construct a climate policy surprise series for California in the same way that Diego Koenig did in his EU ETS paper, if people are familiar with that. But the problem is I would have to demonstrate my sample. But yeah, maybe I'll keep going in the interest of time. So what I have here are some preliminary results on the basis of the signing of the Paris Agreement. So I take that as a jump day. Newspaper reports suggest the signing was really unexpected up until right when it was signed, especially in the US. And on the day, there's a strong negative relationship between abnormal returns and firm level emissions. So it looks like a promising jump day for this application. So I run my inverse regression, and these are the 10 most predictive terms for either negative abnormal returns or positive abnormal returns on the jump day, right? And we see a lot of terms which make me feel like the method is hopefully working. So if you use terms such as which are related to mining or related to exposure to environmental policy, like environmental permits, you're likely to have a strong negative abnormal return response on the jump day. Whereas if you're exposed to green energy, finance, or medical applications which aren't affected by the Paris Agreement, those are most predictive of positive abnormal returns on the jump day. So I aggregate this text up in the way that I said earlier to get exposure scores. And I find these are the 10 firms with the most negative exposure scores, right? So based on my method, we see that, well, the industries and the firms which are most likely to do badly on the day of the Paris signing were those we would expect, right? So mining firms do badly, firms with exposure to oil and gas also do badly. So then I use this exposure score in my forward regressions to test, is the carbon premium there? Where is the carbon premium? And what I find is that contrary to other papers which just use reported and incomplete emissions data, I don't find any evidence of the carbon premium. So the first two rows show 2012 to 2022 and 2012 to 2019, and there's actually a negative premium over those periods, so not significant. And it only turns very weakly and insignificantly positive in 2020. So that's evidence that maybe the market hasn't actually been pricing in these risks. And maybe we should be worried about that remaining unpriced. And this shows that in a different way. So the cumulative excess return of the portfolio, which goes long in highly exposed firms and low in negatively exposed firms, actually earns a negative return. So it loses 60% of its value from 2012 to 2020 and only starts to regain since the pandemic, which is probably what we would expect given the war and energy prices, etc., in the last number of years. So yeah, I think I'm out of time, but this is what I'm hoping to do next. I'm very grateful to have any comments later on if anyone has any.
You can do one more.
Yeah.